Just getting the stream all set so we can dive right in. Should be fun. Hope everyone's having a good trading week so far. We're going to be going live talking about what's going on around the markets here. All right, looks like everything is live here. So welcome. All right. So we're going to talk a little bit about what's going on around some of these key markets. This is a broadcast I do every Tuesday at 9 a.m. with our partners, Bookmap. Really love these folks. So we'll talk a little bit about me first. My real trading journey began in 2005, funding my own account, trading stocks, then moving to options, futures, and Forex. I navigated through the great financial crisis, had a lot of great trades, a lot of terrible trades during that time, but really what that was for me was a formative experience to learn and appreciate the value of combining technical analysis with a more systematic approach with an eye on macro and the financial plumbing, and using that to shape more of my trade ideas, especially on a swing time frame. So that was part of the reason that I started to really get into looking at other asset classes, looking at long short strategies, and other kinds of ways of approaching the market. And so my approach, shaped from that experience, is more systematic. It's driven by momentum, price action, options flows, positioning, as well as volume profile. Then I like to zoom out. I like to look at the big picture. And one of my mantras for swing trades is momentum and macro equal opportunity. When you have both aligning, saying the same thing, you can get some pretty incredible results over longer term trades. I began working with Bookmap in early 2022 because I saw great value in the way their platform, including the heat map, icebergs, and stops, added to my ability to understand what was happening underneath the surface inside the market, right? And as a result of that, I've been able to focus more on finding ways I could add value to the Bookmap platform. And so for me, that's been all about building a plugin called the Advanced SPX Options Visualizer, which allows us to dive in and look at the options flows and how they may be having an impact on the broader market. And we'll talk about that, and we'll look at Bookmap. We'll look at a number of different futures contracts, equities, bonds. We'll be looking at commodities as well as some of the key stocks out there. But before we dive into that, we're going to go through everyone's favorite part of my presentation. This is where I read the disclaimer. All Bookmap limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So you get the point. Do your own homework. Don't just blindly follow anyone, including me. So let's talk some charts. First on screen, we've got the S&P 500, and pre-market this morning, it is still below this key trend line. We lost that trend line last week. We've kind of played with it a little bit, but remain below it. We are above the EMA 21 and the SMA 20. That's your exponential 21-day moving average and simple 20-day moving average. But we are still below this trend line, and I think it's important because this has been the uptrend line for all of 2024. Right? So losing it's kind of a big deal. We're kind of building acceptance below it the more we trade below it. So I do think we're seeing a little bit of change of character here in the momentum of these markets. And I think that's pretty important to take into consideration because it has implications. How are stocks going to trade in this environment where that uptrend is a little bit more fragile, right? So something to take into consideration because we see similar elsewhere as well. We're going to go over to the S&P's high beta brother, the Nasdaq, and it also lost its trend a little bit earlier. It's been struggling to get back above that EMA 21. It is above it pre-market today. Yesterday closed just marginally below it, but we did lose that key trend line that was also the Nasdaq's trend line for all of 2024. Why does that matter to me? Because the Nasdaq's been the momentum leader for some time. So both of these major indices are telling us the same thing. Some degree of caution is warranted. Is the sort of rally completely over and we're all going to die? No, nothing like that. But we see yellow flags that we need to be aware of. Maybe be a little bit more cautious. There's still attractive opportunities hedging 3 and 6 months out at the money puts in SPX, at the money calls in VIX. So those are some of the areas I'm looking to hedge out some of my long risk. Okay. Now let's look at something that may surprise some folks. The Russell is the best looking of the three. I'm just adding a moment of pause there for the people that might be shocked, gasping. Right? But this is interesting. The small caps have actually been pretty darn resilient, particularly in an environment of pretty high rates that are rising. Almost 40% of the Russell 2000 doesn't make any money. Then you've got the finance component, the regional banks. They have a lot of exposure to long duration. So there's almost half of the Russell that's very rate sensitive. And nevertheless, it is grinding higher. So that relative strength is something to pay attention to. The Russell is also a favorite short for hedge funds, which is one of the reasons that when the Nasdaq's getting clobbered, sometimes the Russell catches a bid. It's almost a little counterintuitive unless you look at the way that degrossing happens, right? If you're in a very, very leveraged long short book as a hedge fund, you're long Nasdaq, you're short Russell, and that trade goes against you, you're covering your Russell short. That's boosting the Russell as the Nasdaq goes against you and you sell into that weakness. Next chart we have on screen is the 10-year note futures. We can see that it is just finding resistance at what was once a pretty key level of support. I think this is important too. I still feel like rates in the long end could continue to move higher here. I've discussed in the past 4.5% potentially being a line in the sand where risk assets begin to perk up and take notice how much rates have appreciated. But we'll also talk about real versus nominal on a later slide. It's an important distinction to make. So nominal rates are on the rise, real rates are pretty stable, and we'll talk about that and what that means a little later on. But nevertheless, we do have a 10-year auction this week. I believe it is tomorrow with the CPI data release. Just after 1 p.m., we'll get the results. That'll be an important litmus test. We also get Fed minutes tomorrow at 2 p.m. So it's going to be a jam-packed day of different event volatility catalysts, certainly something that we should be keeping an eye on. And in my opinion, I think that we'll get some pretty decent clues this week as we get CPI, PPI, 3 major treasury auctions of about $120 billion in size, Fed minutes, and otherwise. We'll get some better sense from the rates market as to what its opinion is. But we do see some changes we'll talk about in terms of expectations in just a little bit here. The next chart we have on screen is silver. We've been talking about silver quite a bit. So this week I decided instead of the gold chart, I'm going to go to the silver chart. We all know gold's up and away, and it just continues to make all-time highs, and everyone's sort of aware of that, or at least it's getting greater attention, although it's not the buzz that it would be if we were sort of nearing a sentiment top, in my opinion. People are still pretty darn under-allocated gold, and silver, well, silver's got my attention. So a bit of a backstory. I've been trading precious metals since 2006. So I do like to look out for some of these types of moves here. There's a lot of head fakes, particularly in silver. So you got to be real careful with this metal. I don't think this time is a head fake. Now, maybe I'm going to go out on a ledge and hang myself from saying that, right? But this move has been extraordinary, and it's backed by 2 different sources of demand: increasing investor demand and increasing industrial demand, because silver is a dual use metal. It has both the industrial uses and people like to hold it as a store of value. Some call it the poor man's gold, right? Nevertheless, we can see here we are at a major inflection point for silver. It's had a very impressive run so far, but now it is pushing up. And just for those watching, this is a monthly chart. Now it is pushing up into a very key level of potential resistance. I would expect some higher potential for consolidation here. I don't know that we're just going to zoom right through the zone. If we do, it's incredibly bullish. I mean, this rally in silver has caught a lot of folks off guard. This is the first rally in silver that I've actually believed in a very long time, right? Other than the COVID low kind of, resume to where prices were rally that we had in 2020, 2021, this rally actually looks like one of the best technical setups for the metal I've seen since 2010, 2011. So I'm looking at this very closely. I think if we can break above these current levels of resistance, we do see the potential for this thing going over 30 and potentially over the longer term, retesting some of those all-time highs. Again, it's all about investment and industrial demand. You've got to have both. We do have the latter because you've got more infrastructure, more solar projects, more military equipment, a lot of other areas that are demanding of silver, communications equipment. Those sales are rising as well. So we'll be watching that metal. Let's move on to copper, another metal that has my attention because, like silver, it's breaking out of a long-term trading range, and it looks really, really well positioned here to continue moving higher. Momentum strongly favors the buyers here. This is an area that we identified basically just about 3-4 weeks ago as this breakout was really starting to build and saying, you know what, global copper miners have our attention here. Their relative strength versus the world stocks, VTI, so COPEX versus VTI, if you want to plot that on a ratio chart, you can see the strength. You can see the appetite, the accumulation that's been happening there. And for me, that makes it a very attractive area to invest. We know that there's a significant deficit of copper, right? That's something we keep hearing about. We don't have enough supply. There hasn't been enough production. There certainly hasn't been enough exploration. So if copper demand really does kick into full gear, this just may be a preview of what's to come. The next one we have here is crude oil. This is one we've been talking about pretty much all year long, right? And crude oil has been an absolute winner. It's gone bonkers. There's been a lot of people that were betting against it, calling for $40, $50 oil. That ended up being a bit off base because there is more demand than supply. We do see a global economic cycle forming in emerging markets in its earlier stages as central banks are cutting rates, it's stimulating demand. And then we have geopolitical tensions that are increasing the appetite for oil, for gold, for silver, for Bitcoin, and otherwise. And also, this has made energy one of the best investments of 2024. This is an area we've been early on and talking about for some time. There's been a lot of great winners in this space. Similarly, we believe that this has potential to continue running. And I'll just throw another little outlier there. I know there are folks out there that have absolutely been beaten down mercilessly in natural gas. I've got some good news for you. 75% of the time, natural gas is up in April with an average gain of about 4%. It's the most favorable time of year for seasonality of the stuff. I like XOP, I like FANG, I like other stocks in the natural gas and overall energy space. I think that they may be due for a little bit more of a continuation here. And then finally, we've got the dollar index, and boy, it just can't decide what it wants to do. It looks a little toppy here, although I'm going to see whether or not it closes below 103.81. Pretty darn close, but it's starting to look a little bit toppy here. I think that it's consolidating. I don't know that this is necessarily going to be it getting ready to give up. We do have an ECB meeting. I think they'll be talking about their policy on Thursday. We also, of course, have Fed minutes on Wednesday, along with CPI. We've got all those auctions. What happens to the dollar is really a function of what happens to rates to no small extent. So I'm really watching what happens with the 10-year and how it reacts to all of this data and the auctions, particularly for it, to see where we may get some clues for the dollar. The ECB meeting will be important as well because we'll get a sense as to when they plan on cutting. At MacroVisor, we're looking for June for the ECB to start their cutting cycle, the Fed to follow, and then the BOE to go last. And S&P 5200, that could be a pretty sticky level. It is the second largest full chain positioning level. that we're watching very closely. The first is, of course, 5,000, right? The second, as you can see on screen, is 5,300. When a level has this much options exposure, it can be a bit magnetic. It can act as a key area of support as well. And if we push below it, it's a mighty volatility trigger that can unleash not just selling, but just more erratic trading, right? As you have dealers repositioning, as you have folks that were in these options trades repositioning. So I would just be mindful of that as well. Watch that 5,200 level, not just today, but really over the next week or so. Particularly as we get closer to options expiration. And speaking of options, skew is pretty low. What does that mean? It means this is not a very well hedged market. If we're looking just at skew across the entire chain, it is at levels that are pretty darn low versus positioning, which is pretty darn stretched along with sentiment. So this just tells us there is a heightened risk that if momentum is to shift lower, as we saw with the S&P and NASDAQ, we're kind of close there, losing those trend lines, that sellers may be a little more motivated because you have a lot of positioning that's been added above 5,000, added into record highs, which is fine, except for that positioning isn't well hedged. And so if sellers come in and start to take control of momentum, you've got a lot of motivated buyers that are poorly insured against downside that could begin to distribute into that, adding to that downside. So it just increases the risk of a potential correction in price, time, or both. Next up, gold, Bitcoin, and stocks love low real rates. Okay? Real rates by this measure are about -2% on the 2-year. Why does that matter? Well, it matters because that's one of the reasons that we can say that financial conditions, monetary policy, none of this is tight or restrictive or anything like that, right? Especially as we see inflation starting to come back up. We see some key commodity indices up anywhere between 12 and 17% from their Q4 lows. You've got oil, copper, gold, all these things rallying significantly alongside stocks. And housing prices in many areas are continuing to go up, particularly in the more expensive housing. So what does that tell us? It tells us that we're still in a regime that is pretty easy. And in an easy money regime, gold can keep rallying. Now, what's interesting about this is with all of the turnabout in inflation data, we're starting to see the market repricing the resolve of this Fed. Remember, we started 2024, even before the year began, with 6 cuts priced in. It was a little much. And so now we're starting to see that get priced out. Now there's just 2 cuts priced in, with the first cut most likely in July. And I think that makes more sense, quite frankly. The second cut is more likely to come in November or December rather than September now. September is more of just a coin toss at this point, similar to June. So wouldn't that be interesting if we have a lot less cuts than what is expected, given that if we look at the real dual mandate of the Fed, which is maximum employment and price stability, we can say, well, by the measures they look at, we're at or near maximum employment. And with inflation showing some signs of perking up, we don't have price stability. So it calls into question, what is the real mandate of the Fed? Well, with deficit spending soaring, and no small part because of rising interest costs, maybe one of the third legs of that dual mandate is monetizing the U.S. government's debt. Despite what Bernanke said in front of Congress, you can make a pretty compelling case that that's a big part of what's happening here. So next up, we have the Treasury short is almost non-existent. JP Morgan polled investors that use their clearing services, which is a large amount of high net worth investors, money managers, hedge funds, and so on. No one wants to short. And I'm talking net short. I'm not talking about the basis trade. I'm not talking about commitment of traders where they're actually long, but it shows this really big short position. I'm talking about actual net short. No one wants to net short the Treasury market here. That's a little weird, considering that treasuries just keep falling and falling. The downtrend is pretty well established in a lot of these things. We took a look at ZN earlier, but you can see it on any of these charts. Rates have hit on the longer end their highest levels of 2024 yesterday. So it is interesting. I'm still of the mind that, again, the long end can keep creeping higher. So I think there is opportunity for downside momentum to continue, but this week will be pivotal to deciding that based on some of the data and supply demand information we get. And central bank gold demand has helped to offset declining retail sentiment. This has been pretty interesting. This is the most robust 2-year purchasing period for central banks buying gold ever. Right now, with gold, the way I like to look at it is when everyone you know is talking about it, when it's on the news every night, when there's all these buy sell gold commercials and stores coming up everywhere where retail premiums get absurd and people are still buying, that's when you get closer to a sentiment top. We're not there yet. Just based on my 2 cents. I could be wrong, but having traded this market since 2006, I've seen a lot of gold hype cycles, and we're still in the earlier stages of it. It's not getting as much coverage. It's not being talked about that much. The premiums are rising, but they're not absurd. And the buy sell gold store thing, that indicator still has some room to go. And silver, boy, it has some room to catch up to gold, doesn't it? Look at the comparison between gold and silver here. Silver is very cheap. So there's been folks out there, and I agree with them, saying silver's got room to catch up. I'm right on board with that. I think if gold keeps pulling higher, silver can do what it likes to do, which is where it just likes to rise by, kind of silly amounts day after day after day as it goes parabolic. I don't know if that's exactly what's going to happen next, but the odds of that happening are extraordinarily high. That is to say, I favor more upside in silver, particularly if we can decisively break above some of those multi-year resistance levels that we looked at earlier. And geopolitical impediments to OPEC's ability or desire to deploy spare capacity pose upside price risk. So if the Strait of Hormuz was to be closed for just a month, that could push the price of oil up over $15. A supply crunch from Iran could push up the price of oil by about $7 a barrel. OPEC extending cuts through 2024 could also push up oil by about $6 a barrel. So these are all important considerations, right? Because we are in an environment now where there's a lot more upside risk in oil than downside risk. The biggest downside risk is an amelioration of geopolitical tensions and, at least near term. And that doesn't necessarily seem to be making a lot of progress as talks keep breaking down between Israel and Hamas. So if you'd like to follow my work, you can do so on Twitter and YouTube. My name's the same across both, Mayhem for Markets, Mayhem for Markets. That's the number 4. My trading ideas, coaching, and tools can be found at Traderade.com. The advanced SPX options visualizer that I built for Bookmap is available now. You can check that out at Traderade.com/SPX. And my long-term trading and investment ideas, research, and consulting services for both high net worth and individuals, as well as institutions, are available at Macrovisor.com. I live stream regularly, including for Bookmap every Tuesday at 9 a.m. Eastern, and you can get up to 40% off Bookmap. Check the links in this YouTube, on the Bookmap YouTube stream, on my own YouTube. You can find the links there on my profile on Twitter. If you're watching on Twitter, you can get up to 40%. Just hit that link, scroll down to the special. So now, with all that out of the way, we're going to dive right into Bookmap as we prepare for the market open. And we're going to talk over some of these different markets here. And as I'm, discussing everything here, feel free to ask me questions. I will be checking around the different streams to see if, anyone's popped anything in there that if you want me to look at a stock, if you want my opinion on what's going on around the markets or something else, you're welcome to ask. And you're also especially encouraged to ask if you see anything on Bookmap that you don't understand that you'd like me to elaborate on, or if you're using Bookmap and you have any questions about how it works. There's an amazing team over on the Bookmap YouTube channel that can always help. And they're also on their Discord. They do a great job supporting their clients. So here we are on screen. We've got the S&P 500. We are just about 5 minutes away from the U.S. market open. And pre-market, we've just seen a bit of a bid here over the last couple of hours. We're just sort of building into that. One of the things we saw this morning was this large level of resting liquidity. Sellers could not take us through that. They didn't have sufficient supply to push through that 52.45 level. So I'd say that's a pretty important level here. We got that bounce. It took us above VWAP. The point of control was then dragged higher by buyers. And this is where we're positioned As we get ready to open the market, right at yesterday's most active call strike in SPX, translated to ES levels using my advanced SPX options visualizer. That's one of the reasons it's kind of interesting, because even the next day you can see these levels provide some degree of importance. Similarly, you can see where resting bids were coming in at yesterday's most active put strike, or about 101,000 contracts traded hands. Pre-market, the Nasdaq has a very similar look as the S&P. You had that bid from basically 6:30 a.m. on, and we've just been grinding higher here. As we get ready to open the market here, the futures for equities look pretty bullish overall. And Russell, similar look as well, just had that bid basically from 6:30 a.m. on. And when we look at rates, well, it's pretty much flat here as we look at the 10-year. It's a little bit of a reprieve from the selling that we've seen. That is, we have an overnight bid going into today across the longer end of the yield curve. So maybe a little bit of a sigh of relief in equities for that reason. And gold is very close, within striking distance of $2,400 an ounce. I did spot some unusual flow at CME. Someone put in a spread for the basically a vertical spread targeting $2,900 gold by December's expiration, right? So they're buying the 2,900s, selling the 3,000s to put on that vertical spread. That's a pretty big bet on higher prices in gold, and happening in, well, the next 8 months or so. Silver also looking reasonably sprightly this morning, trading at 28.25, up over 1% this morning. The rally in silver miners that we caught rather early at Traderade seems set to continue here. And copper. This is Dr. Copper. And Dr. Copper's diagnosis of the global economy this morning seems pretty optimistic. You see this across the metals complex, by the way. It's not just gold, silver, copper. It's also platinum and palladium. Just across the board, the metals complex is really well bid. Now, this is going to pose some challenges to the idea that inflation is under control, the genie's back in the bottle, and everything's going to be just great in that sense. But it also means that there are opportunities in different parts of the market. Maybe, in my view, it's time to lighten up a little bit on tech and lean more into industrials, metals and mining, materials. You've got opportunities, of course, in energy, as we've discussed. I also like utilities here because of increasing power demand, and aerospace and defense because geopolitical tensions continue to stay elevated. Crude oil down just a little bit pre-market here. It's about flat, really, down a little bit from its earlier levels, I guess I could say. But this is still, as we looked at, been an incredible performer this year. And I think it still may have some room to run. In fact, it's starting to build a level of interest with all the auction that's happening back and forth at 86 and change that I think will eventually become a key level of support. It was potential resistance earlier, and we saw crude back off and then just blast right through it. Resistance can become support, particularly when you see a lot of interest at that level before the next move continuing the primary trend. And the euro, well, the euro is basically up just marginally this morning. The dollar is losing a little bit of its gusto. Again, it's in this pattern that looks like consolidation. Maybe it turns into a double top. We'll see as time goes on. We've got just about less than 2 minutes before the open. So I'm going to take this back to the S&P. And then when we open, we're going to go through the futures again, but we're also going to go through some key stocks like the Mag 7, the semiconductors. And of course, I'm open to looking at stocks that you're interested in. If you want to send me a note, let me know, hey, I'd like to look at this symbol or this ETF. We can pop that into Bookmap and take a look at that. And I can also look at the gamma levels and see if there's anything interesting going on there as well. And we did get Johnson Red Book earlier. I don't think it's a big market mover, but it did show that there's continued, year-over-year expansion at a nominal level in retail sales. When you net out inflation, it's not quite as an impressive number if you look at real retail sales, but nevertheless, it shows that in some areas, consumers are continuing to consume. All right, market is open here. We're going to zoom in just a little bit more to the microstructure here now that we have the market open. We're going to be focusing on that 20-minute opening range in the Nasdaq and the S&P 500 to get a sense as to whether there is any momentum here to capture. If this is a trading day where I'd want to trade it. See a lot of buying interest here. You can see that these bubbles here are delta. They're volume delta. So the larger the bubble, the more aggressive that one side is. We got a $230 million imbalance to the buy side. Not anything major on the market on open imbalance. We do have some degree of elevated passive buying flows as well as a part of the decay of puts as we approach OPEX. So that can add a little bit of a bid, particularly during the first and last hour. But as we saw with skew, it is a bit subdued. And we do see liquidity building above us here pretty significantly. A lot of that coming on as the market opens. But we also see some interesting resting bids below. So we're going to give this a little time. Again, I like watching that 20-minute opening range. One thing in the buyer's favor is as we're opening, they are pulling the point of control higher here. Typically, that is a bit bullish to see. But again, we need to give it just a little bit more time to see how this all plays out. Let's take a look at the Nasdaq here, also getting a bit of a bid into the open, but some of that's being met by sellers, absorbing those buyers. You can see those larger red dots, and we're going to just zoom in a little bit more here, just so we can see that microstructure. And the Russell just blasting off almost vertically here on the open. That appetite for small caps with their positive momentum remains pretty robust. Rates just a little bit of a bid on the open, nothing too major here. Gold seeing a nice move on the open, up about $5 here in the first minute or so of trading. Silver continuing its rally, and you've got a decent sized resting offer above us. You can see this is not a super liquid contract, right? It's about 6.8 thousand contracts across the bids and offers. So when you see 120 on the offer, it means something, right? Overall has a bullish look to it. And copper consolidating here, not really following with gold and silver, although this is one to continue keeping an eye on. Crude continuing to chop sideways here, consolidating at that key level. Euro getting a bit of a bid, which means the dollar's weak, which is generally bullish for stocks. And we've got semis here. We're just going to zoom into the actual market trading because it's pretty illiquid pre-market. And we can see some of these bids and offers starting to stack up on SMH. It's just sort of consolidating after the open. Apple, similar look here. We're going to zoom into this one as well. Consolidating after the open. You've got that liquidity returning, right? So one of the things you see, and this is one of the reasons it's so dangerous to trade pre-market too aggressively, is that, there's no liquidity there. right? Pre-market, there's really nothing going on. So you're not as likely to get the kind of fills you want, much more likely to get slippage. You see this before major events happen as well, like the release of CPI. You would see something like this, or any kind of event like the Fed before their press conference and before their policy release. You see this disappearance of liquidity. So again, trading pre-market, after-market, and into events and during events can be tricky. Don't do it if you don't know what you're doing. Watch how the liquidity moves before you think about trading this type of stuff, just so you get a better appreciation of risk. And if one is to trade that stuff, smaller size, wider stops are probably the best bet. Amazon taking a bit of a slip here, falling about $1 from the open as we see some liquidity building below here at 186. Looks like it may get absorbed here as well. There it goes. Google had a nice pop after the open, but now, oof, a little bit of selling pressure coming into it, or Alphabet, whatever we want to call it. It'll always be Google to me, though. Just like Meta will always be Facebook to me. And Meta, nice little pop, falling back lower here. We do see that liquidity coming back on the book, 520, a pretty major level in the stock. Microsoft falling on the open here. I'm going to imagine the NASDAQ does not look amazing with all these majors falling. NVIDIA, yikes, just down $10 on the open. And Tesla, another high volatility beast. Pretty much consolidating here, not seeing that same weakness that we're seeing elsewhere. So let's go take a look at the NASDAQ. Yeah, boy, you're seeing some selling pressure increasing there with all the majors sort of giving up the ghost as they were. And again, we talked about the NASDAQ, we talked about the S&P. Remember, there's this key trend line that we're watching. And so far, I'm just going to put it on screen to remind folks if I can. Let's see. See if I can. Nope, it's not letting me do that right now. So basically, there's a key trend line we talked about earlier that the S&P and NASDAQ are bumping their heads on. They lost that trend line, well, the NASDAQ a little earlier, but S&P late last week. And so I think that still there's a lot of increase of angst here. It's no longer quite as certain who's in control, buyers or sellers, from an intermediate term basis. And that could prompt some higher levels of realized volatility during the trading day. I'm very careful to say volatility itself because I don't want to imply implied volatility. The VIX, because there's so many vol selling strategies out there that it has not moved the way it should. Let's take a look at the S&P 500. Similar look as the NASDAQ, getting a little bit of a sell here after a nice open overall. And microstructure so far starting to look like a bit of a downtrend. We have that lower low, that lower high, but we need another lower low first to really confirm it from that basis. And again, we want to see how the first 20-minute opening range really forms here. So we've got just about 13 minutes for that. Let's take a look at our small cap index, the Russell, showing some relative resilience here, versus the NASDAQ and the S&P, where we're seeing a little weakness. The Russell continues to be bid, continuing its positive momentum. And when we looked at that chart, that zoomed out Russell chart, we can see both of those supportive trend lines are still well intact. So it's a little bit easier to go long small caps here, simply because long-term, intermediate-term momentum seems to favor it. Let's take a look at rates here. Just sort of chopping sideways. We do have auctions this week, today, tomorrow, and Thursday. So it will be important after 1 p.m. to watch those results. The biggest thing that I like to watch in these auctions is the size of the tail, if there is one, and the comparison of demand between the two auctions, right? So you can get a sense of that by looking at streams like Financial Juice has a good one, Benzinga has a good one. A lot of the live squawk services provide this stuff right there on Twitter. You can look at the last auction. You can look at the current auction to get a sense as to how demand may have changed. And you can also look at the yield before the auction and the yield, high yield during the auction to get a sense as to whether there's a tail. A tail is when the high yield in the auction is higher than where the yield was before the auction. The greater the difference, the bigger the tail. The bigger the tail, the larger the fail of an auction that is, right? So if you get a big enough tail, it's pretty much a nasty auction and usually pushes rates higher. On the other side of it, if you get the yield, the high yield in the auction lower than where it was the before the auction, and you have greater demand, that can have the opposite effect on rates, right? So it's going to be important. You can set up your own internal report card system and really just focus on the, the bid to cover and the pre-auction yield versus high yield in the auction, and you can get a very good sense as to how good of an auction that was. It's very easy to do once you get a feel for it. Gold continuing to kind of chop here, but overall pushing higher from the open. And remember, this is a very high momentum trade right now. Everyone is late on this trade. This is not a crowded trade yet. So there's still folks looking to buy into these highs and see further potential upside momentum realized. And I think that's part of the reason it continues to move forward. The sheer magnitude and speed of that move caught a lot of folks off guard who had very low allocations to gold, having watched it chop sideways for so long. Silver retreating just a little bit, but like gold, still overall looks pretty constructive here, particularly on a longer term chart. Copper starting to get a little bit demand here. Copper, again, this is one of those commodities that I'm bullish of as a part of this reinflation idea, that the inflation monster really isn't gone. It was just sort of put to sleep for a while. Now it's starting to wake up, stretch its legs, and we can see that in month-over-month CPI. We can see that in commodity prices. We can see that in some of the prices paid in PMIs. We can see that in a lot of different areas, that there is this firming up. There's also a firming up of demand for global goods as manufacturing starts to come out of contraction. So that just tells us there could be some legs to this. Doesn't mean hyperinflation or anything like that. Don't get me wrong. It's more like, hey, maybe the commodity trade is back. And as a result, maybe looking at energy, industrials, metals and mining, materials, things like that makes sense. Crude slipping just a little bit, but again, kind of building acceptance above that 86 and change level. Let's see how it trades today. But overall, this could start to become a pretty important area of support. Euro continuing to move higher, dollar continuing to move lower, with 40% of S&P 500 company revenue coming from overseas. A weaker dollar is typically beneficial for the index. Semis finally starting to catch a bid here after the open. Let's see if we see some improvement in some of these other heavyweights. And we're just going to zoom this out to 930. Yeah, Apple starting to look pretty darn constructive here. Got a lot of resting supply here at 170. Let's see if it's able to take that out. Amazon, after selling off earlier, starting to find a bid here, but still well off of its pre-market highs. Google, again, we're just zooming out to get all these on screen. Google looks pretty good after that slip. It came right back up, made a new high. Now it's consolidating here. It did find resistance around 158, where there's about 26,000 on offer. So that level could be one to watch. Meta seeing a nice bounce just above this large area of resting liquidity. When you see those bounces, when sellers don't have the supply to take us through those levels, that's bullish. Similarly, if it was to be reflected lower here, that would be bearish. Instead, buyers absorbed this supply overhead. That's a pretty bullish outcome. You can see it in that large green bubble as well. That supply was consumed, it was absorbed, and it looks like they're hungry for more. 525 is the next level to kind of watch on this thing, but nothing really gets my attention until we look at these higher levels like 526, 527 in terms of the amount of supply there. Microsoft came right back, zooming higher. You've got a large resting offer here at 430, about 56,000 on offer there. But let's see if we can get through these higher levels. So far, it's looking a bit more bullish. Remember, this thing pulled back earlier, right out of the open. It pulled back, but now we've seen a reversal in that microstructure, making a higher low and a higher high. So overall, Microsoft looking pretty good. NVIDIA also recovering like its peers. Bit of a head fake there, right? You can see that, the magnitude of that. I'm sure some people got stopped out, but it's starting to recover. It doesn't look quite as good as Microsoft or some of the others, but it's still showing that it's trying to carve out a bottom here. And then Tesla doing Tesla things, right? We see 175, 158,000 shares on offer there. That's probably going to be a pretty important level, but overall shares look decent above the point of control and VWAP. Going back to the S&P 500 here. So someone asks, when it comes to options impact on NQ, do you pay more attention to options data on triple Q or NDX? I pay more attention to triple Q because there's a larger amount of premium changing hands, and so the hedging requirements are higher. But I would also say that the NASDAQ is a completely different beast than the S&P futures. There is 1.2 trillion of notional trading in S&P 500 index options every day. That is more than pretty much like all the rest of the options market. So it's pretty nuts, right? In that sense, like the S&P options really do have a tremendous role influencing price discovery. In triple Q, it's nowhere near that magnitude. So I'd say it's important, but less so. For the NASDAQ, what I really like to watch are the options in the heaviest weighted stocks. So looking at Microsoft, Apple, NVIDIA, Google, Amazon, Tesla, those options flows, I think, give me a little more clarity as to what's going on in the options and what may influence the NASDAQ more than just triple Q alone. Let me know if that's helpful. All right, so we got a lot of different data traffic coming through, enough that I mean, I do have like 18 symbols open, so sometimes that might get a little bit much. Nevertheless, S&P not looking quite as good as the NASDAQ overall here. Now let's zoom out again, because again, we're looking for that 20-minute opening range, right? So we want to make sure we keep that everything from the open on screen, right? So we can see like this is the high end of our range, just about 52.7450. So far, the low end of our range is 52.64. So it's not a very big range right now, about 10 points. Let's see if that grows as time goes on. We're starting to see the options activity print here too. The advanced SPX options visualizer is seeing enough activity on CBOE to start pulling that data in. We can see there's more demand inputs than calls right now, and the most aggressive demand is in this hot put, which translates to the ES level about 52.38. So just keep that in the back of your mind as we zoom back in. Yeah, you're very welcome. I'm glad that was helpful. The biggest thing with options to take into consideration for everyone that's listening that may not be in tune with like how they work is really understanding how options activity can impact the underlying, right? So if I'm a market maker and I'm selling call contracts on NVIDIA, I've got to hedge my delta, right? What that means is, in simple terms, I've got to make sure that I have enough exposure to NVIDIA shares that if I have to pay out those calls, I'm not losing money, right? So you're hedging your delta. The delta just gives you an approximate sense as to how much you need to hedge as a market maker. Like for NVIDIA, if it was a 0.4 delta, you're basically hedging 40 shares for every call contract that you're selling. Now, there may be variants in other Greeks as to how exactly that plays out, but that's the rough back of the napkin take. Why does that matter? Because that's the primary price discovery mechanism for NVIDIA right now. It is the most actively traded stock in terms of options out there by far. In fact, it accounts for about a fifth of all options premium in single stocks right now. So it's kind of taken Tesla's mantle where it was in 2021. So understanding those options flows, watching them, especially if you're trading the stocks that they're impacting, can give you a little bit more of a framework of what we might expect from price. And we see the S&P here starting to slip We see this large area of resting liquidity right below around 52.60. There were a lot more on offer. Some of that's been, or I'm sorry, on bid. Some of that's been absorbed, but we still see about 294 on bid here. Now, if buyers are absorbed here by sellers, that does open us up to some more downside. We could see a larger resting offer coming in right here as well. So we're going to be watching some of these key levels. We'll also look for any kind of convergences that we see, like with this warm put. This is a level of interest that is also shown there's that convergence with that resting bid. This is another reason the advanced SPX options visualizer is helpful, because it shows you more than one data point to illustrate the importance of certain levels. And then this vol trigger here around 52.50, this lines up with where we have enough positioning that if we're to push below it, we're going to increase realized intraday volatility because of the way that positioning is going to potentially change how dealers hedge. So it's an important enough level that it's automatically marked. We're also slipping into negative gamma territory based on the naive model that we use to make these calculations. That gamma flip level was just pushed under. So as we build acceptance below here, this does open us up to, again, more volatility. Now, if you're a trader, that's probably music to your ears, but if you're not familiar with what this means, it means you're likely to see larger price ranges, greater expansion, okay, of volatility intraday, particularly if we get below that vol trigger. So for me as a trader, what that means is if we do see that starting to play out, if I'm taking a trade, I'm using smaller size and wider stops to account for that change in the trading environment. So now we're going to zoom out again, because now we do have our 20-minute opening range, right? This low right here around 950, let's call it 52, and this high around 74.50, right? I'm sorry, yeah, let's call that, I'm going to zoom in a little bit more to get a better read. We'll call it 58 on the low and 74.50 on the high. So we are pushing below the bottom of the opening range. Now, what I like to say is let's build a little acceptance here. Show that sellers really are in control, that this isn't just a head fake lower. And then I'd say we are prone to have more likelihood of a downtrending day, but that opening range being as small as it is suggests that it may not be that wild. Now, again, what could add to that is if we do start to see some push, right? We also see some shifting around in positioning, but we do have the midpoint painting on screen. What does that tell us? The midpoint means that now that we've had a little bit more time to realize how options are trading, there's about a 20% variance between the top two puts and top two calls total transactional volume, which means that this is a market that's more imbalance, okay? If we look at auction theory, I look at 3 different dimensions to the auction, right? You've got 3 different kind of outcomes. You've got excess supply, you've got excess demand, and then you've got a balance between the two. Those are the 3 states of an auction for whatever is trading in the market, right? So right now, if we're just looking at options, we're saying that we're in a market that's in some degree of balance. And that midpoint just came on screen within the last several minutes. So just important to contextualize that. When we're looking at this through the lens of the heat map, we see liquidity above fading. You can see how much more there was on the heat map when price was closer. We see as we slip below this point of control, liquidity began to fade. As we went below the VWAP, even more, and we start to see downside bids growing. So there's more interest in lower price. That's another key area of the auction as well. We also saw that warm put level and that hot put level move lower. You do see interest in these put buyers in lower prices. And these really small bubbles here, what you're seeing is there's not a lot of conviction from either side. Again, kind of speaking to that market imbalance idea. No one's taking control of price yet here. This is another reason why I like to see some acceptance built. That's kind of what we're doing here below the bottom of the opening range. So again, we're favoring more downside, but we're sort of in the process of, I would say, increasing the probabilities of that outcome as we build acceptance below the bottom of that opening range and as we see liquidity building below and fading above. And in terms of where this could go, I would say that 5200 SPX is still the most important level to watch. That's just around where that hot put is trading as well. And in fact, the warm put is around, yeah, it looks like we do have some shifting of positioning that's starting to happen here. So you got a lot of demand at 5190, 5200, and 5220 on the put side. On the call side, 5230 and 5250 in terms of SPX levels. And I always like to look at unusual flows on both sides of the single stocks and ETFs, as we've discussed in the past. Sometimes they can give us a little bit of a clue if it's lopsided, but you know what we're seeing there? We're seeing there the same thing that we're seeing in the advanced SPX options visualizer, some degree of balance. There's a little bit more unusual demand for calls than puts, but it's pretty much a draw. So I've got just about 4 minutes left on the stream. If anyone has any questions about anything that I'm showing, please feel free to ask. Also, check out my Twitter, my YouTube. You can find me on both. Mayhem 4 Markets. That's Mayhem number 4 Markets. Check out the description in the YouTube if you'd like to take advantage of up to 40% discounts on Bookmap. You can just scroll down to the specials. You can also check out the advanced SPX options visualizer on the Bookmap Marketplace by visiting traderade.com/SPX. And speaking of Traderade, that's where we help you find your edge trading these markets across multiple timeframes and asset classes. Check us out for our trade ideas, education, and community, and visit macrovisor.com, where we combine macro and momentum to find longer-term trading and investment opportunities all around the world, and where we're preparing to do a live stream this Friday. So I hope you can join us around 12 p.m., where we look at our Q2 outlook and share our overview of the global markets, the macro, and our ideas for trading and investing in the second quarter of this year. And finally, be sure to check out Bookmap. They've got a great Discord, an awesome community. I love the folks there. It's the longest partnership that I've had with any company in this space. It's been fruitful. They've been awesome across the board, and it's because I love their product. I don't get behind anything I don't use. So I'm a little different than some of the folks out there that you might call a quote influencer or whatever. You'll see how I, kind of run my feed. I don't talk about anything that I'm not using. I use Bookmap every day. So it's one of the few tools that I can get behind and say, yeah, that one. Obviously I like other tools out there. There's TradingView, there's TrendSpider, there's MotiveWave. Those are also great, but Bookmap, I always keep coming back to them because not only is it insightful for me across a variety of different asset classes, but it's also easy for me to build into. Like when I built the advanced SPX options visualizer, I just built it for myself at first to help my trading. Then I shared it with the Traderade community. And then after I felt all the bugs were fixed, I was like, you know what? Let's make this thing live for the whole world. Everyone could benefit from seeing what institutions typically only see or look at. So got just about a minute left here. Want to thank you all for tuning in. I'll be back next Tuesday at 9 a.m. Eastern on Bookmap, talking more about what's going on in futures, equities, currencies, and rates. A little bit of a boring day in the markets here, a bit of a paint drying simulator 2024 replay, but maybe things will get a little bit more exciting. We are building acceptance below the bottom of the opening range in the S&P. NASDAQ has a similar look here as well. Russell is kind of content to ignore everything going on around it. It did sell down, but, this is still looking pretty bullish comparatively speaking. Gold pulling back just a little bit, but consolidating its gains. And silver pulling back a little bit, but overall just sort of consolidating its gains here. Copper continues to look constructive overall, especially on the intermediate term. Crude consolidating at that key level we talked about, sort of building acceptance. Euro fading a bit, coming down off of its high, so dollar showing a little bit more strength here. Semiconductors pulling back and actually making some new lows here, so not looking too great there on the semis. Apple, let's zoom out here. Yep, showing some strength overall. Although if you zoom out on that chart too far, you see it looks pretty precarious. Amazon consolidating after those losses just above a key bid. Google having decent strength, coming back and then retesting those highs, taking out that resting offer and consolidating, showing some relative strength compared to the overall market and some of its peers. Meta still looking pretty bad here. Microstructure suggests further downside in a downtrend. Microsoft just sort of consolidating sideways after that sell. And everyone's favorite stock, Nvidia, looks like it just made new lows or very darn close. That 862 level, one to watch. And finally, we'll round it out with Tesla here. Tesla looking comparatively better than a lot of the other Mag 7 stocks. So this has been Back to the Futures with me, Markets and Mayhem. I hope you enjoyed it. I'll be back next week, Tuesday at 9 a.m. See you then.